Even when price is staying near record highs after a stock split, a trend-based Fibonacci time zone can still be applied, similar to how a Fibonacci extension can be applied. This method is often well suited for such situations when a chart moves to new record highs or lows. This is because the established base trend often has a series of retracements from a clear swing point defining current record highs or record lows. Unlike a Fibonacci extension analyzing price, a trend-based Fibonacci time zone can use a pair of downswing or upswing points for points 2 and 3. It is also possible to choose a variety of swing points for point 3. Adjusting point 3 can be done to adjust the position of the entire set of interval lines. The greatest effect on the length of the intervals is from the base trend. In this case, trend lines can also help identify areas of potentially greater importance. When they intersect with extension levels and interval lines, the main events of interest are bearish reversals and bullish continuations. Then when 2021 begins with clear downtrend development, the main focus is on identifying the time frames for support to succeed and produce upswings, or fail and produce bearish continuations. The only exception is the return to resistance near 800 at interval 1, which focused attention back to the possibility of a bearish reversal taking place around April. As usual, too short of a base trend is not very useful, even if point 3 is extended far to the right. Similar to a normal Fibonacci time zone, the trend-based Fibonacci time zone can be placed further back in the past to try and have interval lines intersect with significant events that have already formed on the chart. In this case, shortening the base trend and using an earlier clear retracement has the 1.382 interval run right through the middle of the current peak. This adds validity and points to the intervals after 1.382 being quite useful in the downtrend that follows. A minor adjustment of point 3 runs interval lines through many important features as well, but it is more applicable to the continuation context of the uptrend and less so for the reversal and continuation into the downtrend. This is because the interval lines up to 1.382 are mostly running through bullish features in the uptrend to validate the reliability of the trend-based Fibonacci time zone more for bullish context rather than the bearish context of the later downtrend.